What if everything you thought you knew about the markets was being secretly controlled? Today, we're peeling back the curtain on one of the most critical and controversial aspects of trading: market manipulation. I'm your host, and in this video, we'll dive deep into the hidden tactics that distort market prices, uncover the players behind them, and reveal how you can not only protect your investments, but also potentially profit from these deceptive moves. Let's start with the fundamentals. Market manipulation occurs when individuals or groups intentionally distort the price of financial instruments to create an unfair advantage. This isn't just a topic for conspiracy theorists. It's a real, documented phenomenon that spans across stocks, Forex, cryptocurrencies, and commodities. Manipulators use tactics that send false signals to the market, creating illusions of demand or supply that lead unsuspecting traders into poor decisions. In essence, while you may believe you're trading on genuine market data, you could very well be reacting to a carefully orchestrated illusion. Today, we'll expose several common manipulation tactics, review real-world case studies, and then share actionable strategies to help you navigate and even profit from these murky waters. Market manipulation isn't a modern invention. It has been a part of financial markets for centuries. From the trading pits of the 20th century to today's algorithm-driven exchanges, the tactics have evolved, but the objective remains the same: profit at the expense of others. Look back at infamous scandals like the 1980s junk bond crisis or more recent crypto pump and dump schemes. Each case teaches us how manipulation adapts to new technologies and regulatory environments. By understanding this evolution, we can better predict and recognize manipulation in today's markets. The history of market manipulation reveals a persistent pattern. Those with significant resources will always seek ways to influence markets, regardless of the era. While technology has changed the mechanics, the underlying psychology remains the same. Learning from history not only prepares you to spot red flags, but also helps you build strategies that work in any market condition. First up, the infamous pump and dump. This tactic involves artificially inflating an asset's price through hype and false information, only to dump it at the peak, leaving retail investors with massive losses. Key signs to watch for include unexplained, rapid price increases, unusual volume spikes without any credible news backing the move, and aggressive promotion across social media and chat groups. Remember, if an asset's price is skyrocketing without a solid reason, be extremely cautious. Next, we have spoofing. Here, traders place large orders with no intention of executing them. These orders create the illusion of high demand or supply, only to be canceled moments later. A related tactic, layering, involves placing multiple orders at different price levels to further manipulate market sentiment. These tactics can mislead even experienced traders. Always focus on actual executed trades rather than just the order book, and monitor the speed and consistency of order cancellations. By understanding spoofing and layering, you can learn to look past the noise and base your decisions on real market activity. Have you ever noticed your stop loss being triggered only for the price to reverse shortly after? That's no accident. This is known as stop loss hunting. Manipulators deliberately drive prices to common stop loss levels, clearing out weak positions before reversing the trend. To protect yourself, consider placing stop losses away from obvious levels like round numbers or previous highs and lows, and using wider stop losses combined with precise risk management techniques. By adjusting your stop loss strategy, you can avoid getting caught in these traps and keep your trades intact. Let's look at some real-world examples to see these tactics in action. Over the past decade, multiple high-profile cases have exposed market manipulation, from sudden pump and dump events in cryptocurrency markets to orchestrated spoofing scandals in equity markets. For instance, consider the case of example case A in the crypto space, where coordinated pump and dump schemes led to dramatic price surges followed by equally dramatic crashes. Or examine incidents in traditional markets where spoofing artificially inflated volatility before regulators intervened. These cases illustrate that manipulation is not just a theoretical risk, it's an active threat. Studying these events helps us understand the warning signs and improve our defensive strategies. These real-world incidents underscore the importance of staying vigilant and learning from past manipulation tactics to protect your trading capital. Now, how can you use this knowledge to your advantage? Let's talk about actionable strategies. Always cross-check information from multiple reliable sources before making a trade. A well-informed decision is your best defense against manipulation. Use technical analysis to verify price movements. Look for patterns and volume confirmations that indicate genuine market shifts rather than manipulated anomalies. Risk management is key. Never risk more than a small percentage of your portfolio on any single trade. Use proper position sizing and always set your stop-loss orders to limit potential losses. Pay attention to where the smart money is moving. Look for liquidity pools and order blocks. These are the areas where big players are active. By aligning your strategy with institutional flows, you can often ride the wave of genuine market moves. Regulatory bodies around the world are continuously working to curb market manipulation. While stricter regulations can reduce some forms of manipulation, they also push manipulators to innovate new tactics. Staying updated on regulatory changes can help you anticipate shifts in market behavior and adjust your strategies accordingly. The future may bring more transparency, but also more sophisticated manipulation techniques. Staying informed is your best bet. Before we wrap up, let's take a few questions from you, our community. I've received some great questions about market manipulation and how to spot these tactics early on. Great question. Look at the volume and check for any credible news. If the spike seems isolated and is accompanied by a massive volume surge without substance, it could be a pump and dump. Focus on using wider stops in less obvious areas and incorporate multiple confirmations, like volume and price action, before entering a trade. Your questions are invaluable in helping us all understand the complex world of market manipulation better. Keep them coming in the comments. Market manipulation may seem like an insurmountable challenge, but knowledge is power. By understanding these tactics, employing robust risk management, and staying informed, you can protect your investments and even turn these manipulative moves to your advantage. If you found this video insightful, please give it a like, share your thoughts in the comments below, and subscribe for more in-depth analysis and trading strategies. Remember, the more you understand the market, the better prepared you are to navigate it.